Closing entries demonstration. The purpose of closing entries, one primary concern in closing entries is to reset the revenue, expense, and dividends accounts, which are called the temporary accounts, to a zero balance. And the asset, liability, and stockholder equity accounts, namely capital stock and retained earnings, are real or permanent accounts. In other words, a temporary account is one that we use throughout the year and we'll empty out, zero it out at the end of the year to start all over for the next year. However, permanent accounts roll over to the next year. The second purpose of closing entries is to move the balance of all the revenue, expense, and dividend accounts into the retained earnings account. You'll remember that we have been saying all along that retained earnings is basically an accumulation of revenues minus expenses minus dividends. Prepare closing entries in the format used by accountants. To do this, first we'll close the revenue and then the expense and the dividend accounts in the following order. Close the revenue accounts into the income summary. The income summary is what I consider a very temporary account in that it's only used for this process. Then we'll close the expense accounts into the income summary. Then we'll make sure that the balance in the income summary equals the net income. If it doesn't, then we're going to have to go back and correct entries from either entry A or B. Then we'll close the income summary to retained earnings. Then we'll close dividends, the dividends account into retained earnings. After you've completed all these entries, then we'll compute the balance in retained earnings. And these are the beginning balances in the T accounts before closing. We have 6 accounts. We have service revenue, salaries expense, rent expense, dividends, income summary, and retained earnings. These are the accounts that we're going to be using for our demonstration. Transaction A that we're going to use is, which we started with in the list, was to close revenue accounts to income summary. And to do that, we know that revenue accounts have a normal credit balance. Therefore, to close them, we need to debit them. So we're going to debit all the revenue accounts that we have, and we're going to credit the total of those to the income summary. So in our case, we have service revenue as our only revenue account in those 6 that we have. So we debit service revenue $3,500 and we credit income summary $3,500. The next entry is to close the expense accounts to the income summary. Expense accounts have a normal debit balance. Therefore, in order to close them, we need to credit them in order to zero them out. So we're going to credit all the expense accounts we have, each one, and the total of all those, we're going to debit the income summary. So in our case, we have salaries expense and rent expense. They have a balance of $1,400 and $600 respectively. So we credit each of those accounts by those amounts. The sum of those, the $1,400 and the $600, is $2,000. Therefore, we will debit income summary for $2,000. The next thing we would do is, if we had something to compare to, is we would make sure that the balance in the income summary equals net income. If it did not, or doesn't, then we would correct the entries from either one of those last 2 entries. The next thing we're going to do is close income summary to retained earnings. Now we have 2 possibilities. We could have a net income situation or we could have a net loss situation. If we have a net income situation, meaning our revenues are greater than our expenses, then income summary is going to have a credit balance, so we would have to debit it in order to reduce it to 0 and then credit retained earnings for that like amount, which makes sense because we know retained earnings, being an equity account, has a normal credit balance there, and we know net income would have to increase it, so it would make sense that we would increase it by the net income amount. The other possibility is a net loss. If we had a net loss, then our expenses would be greater than our revenues, and therefore income summary would have a credit balance, and so we would credit income summary and debit retained earnings in order to reduce retained earnings. our situation, income summary will have a $1,500 balance based on the revenues and expenses that we closed in entries A and B. So we would debit income summary for $1,500 and credit retained earnings for $1,500. Finally, we close the dividends account to retained earnings. Dividends have a normal debit balance, therefore we will decrease them with a credit. So we credit dividends and we debit retained earnings. Of course, debiting retained earnings decreases it. So in our case, we have $1,200 of dividends, so we are going to debit retained earnings $1,200 and credit dividends $1,200. Now, to see the postings of the T accounts, I have all 6 T accounts. Their original balances are in the non-bolded numbers, and so the first entry, debited service revenue and credited income summary for $3,500. The second entry, credited salaries expense and credited rent expense and debited income summary. The third entry closed this income summary by debiting $1,500 at income summary and crediting retained earnings for $1,500. The next entry closed dividends, so we credited dividends $1,200 and we debited retained earnings $1,200. And then the next thing would be to calculate the ending balance of retained earnings. You notice retained earnings has one item on the left side, the debit side, of $1,200. It has the original balance of $10,000 on the credit side with another credit of $1,500. So if we add the credit side, $10,000 and $1,500, we'll get $11,500. And we subtract from $11,500, we subtract $1,200, and we end up with the $10,300, which is our ending balance.